Strategic briefing. AI governance and the 2026 regulatory horizon. We are entering a pivotal window for the global financial sector. As we move into 2026, the conversation around artificial intelligence has fundamentally shifted from technical curiosity to core fiduciary responsibility. We have moved past the era of pilot projects and experimental use cases. Today, the mandate for C-suite leaders is industrialization. And with that industrialization comes a new, more aggressive landscape of material operational and legal liability. For the modern CEO, chief risk officer, or board member, AI risk is no longer a localized IT issue. It has evolved into a critical pillar of model risk management and your broader operational resilience strategy. Regulatory bodies, from the Federal Reserve in the US to the MAS in Singapore and the JFSA in Japan, are now demanding proof of active governance. They are moving beyond high-level ethical principles and into the granular examination of materiality assessments and data lineage. The cost of inaction is no longer just a missed opportunity for efficiency. It is a material threat to the bank's right to grow. We are already seeing supervisory actions that don't just result in fines, but in the freezing of new product launches and the imposition of independent monitorships. By understanding the implementation gap between frameworks like SR 11-7 and the EU AI Act, your institution can move from static box-ticking compliance to a model of continuous AI compliance monitoring that protects both the balance sheet and your standing as a fiduciary. Governance is the foundation of this effort, acting as the primary anchor for the three lines of defense model. However, as we look toward 2026, regulators are noticing a growing gap between policy and practice. In the U.S., the Federal Reserve's SR 11-7 remains a critical benchmark for model risk management, but it is being applied with new vigor to generative and agentic systems. The primary challenge for the modern executive is the black box problem. When an AI system makes a credit decision or a liquidity forecast, can your internal audit team explain precisely why? This isn't just a technical requirement. It's a legal one. Under Basel III Pillar 3 disclosures, banks are increasingly expected to provide transparency regarding the risks embedded in their quantitative models. If your AI-driven risk calculations lack this transparency, you are essentially inviting a capital add-on or a public enforcement action that can damage market confidence overnight. To put this into perspective, consider the case of a major tier, one bank that recently faced a matter requiring immediate attention notice. Their model inventory automation was found to be incomplete, largely due to shadow AI, unauthorized tools used by employees to process sensitive client data. Because they lacked a centralized automated registry, they couldn't perform a proper materiality assessment. This failure led to a 6-month freeze on their digital expansion and a significant hit to their reputation during a critical merger phase. From a boardroom perspective, it is critical to understand that the duty of care now extends to this type of algorithmic oversight. You cannot delegate the ethics of an automated decision to a vendor. In the eyes of a regulator, if the board hasn't approved the risk appetite for a specific AI deployment, it represents a failure of oversight. Personal liability is no longer a distant threat. It is the natural consequence of a set and forget governance mentality. We must shift our thinking. AI is not a tool we use. It is a system we govern. Moving into the realm of operational resilience, we have to consider the bank's ability to absorb and recover from a disruption. In the AI era, a disruption isn't just a server going down. It's systemic contagion risk caused by a hallucinating model or an uncontrolled feedback loop. Under the EU AI Act, specifically Article 10, high-risk systems used for credit scoring or insurance underwriting must adhere to strict data governance. This requires continuous AI compliance monitoring. You simply cannot wait for an annual review to discover that a model has drifted into bias or is producing erroneous outputs. In financial hubs like Switzerland, Singapore, and Hong Kong, the focus is heavily on explainability and fairness. The MAS FEAT principles in Singapore are now being used to judge whether a bank's algorithmic kill switches are effective. If a model starts showing bias, the regulator expects you to have the capability to decommission that model in real time. We saw the weight of this last year when a European lender faced a significant fine because their AI-based fraud detection began redlining specific regions based on flawed training data. Because they lacked real-time materiality assessments, the bias went undetected for 3 quarters. The remediation costs, including the rebuilding of the model and re-evaluating thousands of denied applications, exceeded 40 million euros. Directors must realize that in this environment, transparency is a proxy for trust. A black box is a strategic liability. You should be demanding a model health dashboard that reflects real-time performance and compliance status. If your team cannot explain the logic of an AI to a regulator within 48 hours, you do not have an operational model. You have a ticking litigation time bomb. Looking at this from a director's liability standpoint, the question is no longer, did the AI make a mistake? But rather, did the governance framework catch the mistake before it became systemic? Perhaps the greatest hidden risk in this stack is not what you built, but what you bought. Third-party risk management, or TPRM, has become the frontline of the 2026 compliance landscape. Most banks are plugging into APIs from large tech providers rather than building their own models from scratch. However, you cannot outsource your accountability. If a vendor's AI fails or violates a privacy mandate, it is your Pillar 3 disclosure that will be scrutinized. Regulators in Japan and Hong Kong are now requiring banks to perform deep dive audits on their AI vendors, looking for proof that the training data is compliant with local privacy laws and ethical standards. In one recent case in Hong Kong, a firm was censured when it was discovered that their AI advisor tool was sending anonymized client data to a non-compliant jurisdiction for processing. Because they hadn't implemented model inventory automation, they didn't even realize the tool was still active and collecting data after the initial pilot ended. This failure of TPRM led to a mandatory audit that cost the firm triple the original vendor contract and caused a significant breach of client trust. The board must recognize that vendor risk is now systemic risk. You have to ask what the exit strategy is if an AI provider is compromised or suddenly changes their terms of service. Resilience isn't just about uptime. It's about the legal and ethical integrity of your digital supply chain. Fiduciary duty requires you to look past the contract and into the code, ensuring that your third-party risk management is as robust as your internal controls. As we look toward the 2026 horizon, active governance is the only sustainable path forward. This implementation gap will separate the institutions that are simply surviving from those that are thriving through superior risk management. Banks that invest in model inventory automation and continuous AI compliance monitoring are building a governance premium that lowers their cost of capital and increases shareholder trust. They are making their Pillar 3 disclosures a statement of strength, signaling to the market that they have mastered the complexities of the digital age. To conclude this briefing, there are 3 priority actions for the executive team. First, mandate a comprehensive materiality audit for every AI use case currently active or in development across the bank. Second, institutionalize the 3 lines of defense for AI by ensuring your risk and audit teams have the technical literacy to provide an effective challenge to your developers and data scientists. And finally, audit your TPRM framework to move beyond simple vendor surveys and into rigorous evidence-based proof of bias testing and data security. The transition from theory to liability is complete. The question for the 2026 fiscal year is no longer whether you are using AI, but whether you are governing it with the same rigor you apply to your capital, your credit, and your market reputation. By bridging the technical with the tactical, your institution can navigate this regulatory landscape with confidence, ensuring that AI remains a driver of long-term value rather than a source of unforeseen systemic risk. To conclude this briefing, there are 3 priority actions for the executive team. First, mandate a comprehensive materiality audit for every AI use case currently active or in development across the bank. Second, institutionalize the 3 lines of defense for AI by ensuring your risk and audit teams have the technical literacy to provide an effective challenge to your developers and data scientists. And finally, audit your TPRM framework to move beyond simple vendor surveys and into rigorous evidence-based proof of bias testing and data security. I'm curious to hear from those of you operating in the UK or Singapore. How is your internal audit team currently bridging the gap between Article 10 requirements and existing TPRM protocols? Let's continue that discussion in the comments section below. If you found this briefing valuable, I invite you to join our community of compliance leaders and senior executives. We provide these strategic updates weekly to help you stay ahead of the evolving AI regulatory horizon. Thank you for your time. This has been a strategic briefing for the Global Banking Executive.